Happy Thursday. Nice to be with everybody today. Let me go ahead and show my screen. And if you're looking at me like that guy doesn't look like Nick, you're right. It's not. My name is Chris Pulver. Nice to be on the show with you. And let's kick things off with a little bit of top down. I was just doing some back testing. I'll share that in just a moment. I went into a bit of a deep dive yesterday with some option strategies, my core strategies. And yeah, so today I'm long the SPY up to 548. I've got a 64-cent debit on a call spread, or just a call. Actually, it's a long call for a 1 DTE. I'm out to Friday. Tomorrow is the end of the month. Tomorrow is also the end of the quarter. We had some light earnings coming in. I saw Walgreens was down. I do own some shares in that. I'm a little disappointed that they're down $3 on a $15 stock that's now down to $12. So I'm looking at probably an easy way to repair it, but not wanting to just dump, capital at kind of a silly, a silly stock and try to, well, either way, I'll do the math to see if I need to double down on it, but I'm probably not going to. I just have a collar trade, which means I have a covered call and I have a long put. So I'm essentially protected to the downside, but I'm still annoyed seeing the stock go lower. Let me see this. Okay. Comments wise, all good. Good morning, everybody. And let's have a look at everything. So I'm willing to take a lot of requests on charts and technicals. Frank wants to jump in here with me. Great. He and I can nerd out about some stuff. And anyway, we're looking at the SPY at 546. Things are fairly quiet. The week thus far, not much going on. The week has edged out a slight green candle. That's my shaded green in the background. We had an immediate pop to the upside to retest the high from Monday around 546, almost 547. Why am I long to 548? Here is some software that I have through Dynamic Trends and through one of my trading rooms. One of my courses is called Delta Trader. 548 is this big fat level right there. You can see that there's really nothing else on the chart. So 548 is also a huge open interest size. And so between 548 and 550, I'm looking to see if the SPY can get there by tomorrow. If it gets there today, great. I'll still have some more time left in the trade. Gets there tomorrow, and then my at the money will be trading for hopefully like $1.50 to $2. So I'm in this for a 64-cent debit. It was just a long call. So let me type this out here. So I did a 628 expiration. This is on the SPY. And it was a 548 long call for 64 cents debit. So that is the trade that I'm in. If we get to a, let's say 45 or 50 delta, that is $1, we'll say $1.85 away. The delta is probably like a 30 or so, something right now. As I was calculating that earlier. So if we're sitting on a 30 delta and we move $1.80, actually in this case $1.90, that's another 57 cents added on top of my trade. That's just like conservative calculation plus the 64 cents. If I close this out by later today at $1.21 credit, that's fine. I'd obviously like to see it, not just get to 548, but maybe a little bit higher. If I can get $1.50, $1.60, that'd be pretty good overall. But I'll be watching, see if the market's interested in finding a level today. And here where, like I said, just squeezing out a little bit of a gain on the week. Okay, US 30. Here we go. Yeah, let's talk about it. US 30. We're talking about a little bit of divergence between these indexes. So if you're looking at US 30, closest resemblance to that is the Dow, right? You're looking at the S&P 500. We've had some all-time highs notched in the S&P, all-time highs notched in the NASDAQ, the Dow. When we had this kind of double top here, actually, I take that back. It's not really a double top, and I don't know if I had mentioned this in the A1 trading session, but to me, this looks like a pretty classic ascending ascending wedge, something like that. So if we have a low to high swing from this October low of last year, if this Dow continues to test resistance, some of you might look at this and say, well, that's the top. Not necessarily. If it's an ascending wedge, usually that is a bullish sign that we have the ability to break and go higher. Okay. So if we're going to see higher highs by the end of the year, this is pretty good structure on the Dow. All right. So the US 30 to me, I mean, again, I'm not talking about today. I'm talking about over the next maybe 3 to 6 months. If we kind of stay in this structure, we go sideways for a little bit. Markets are looking for a new catalyst to kind of lift it up higher. That would be the direction I'm looking to trade. Okay. Now, if we were going to go lower, then we'd have to break that structure there, which has not happened. So I've looked at this on all the indexes. It is hard to justify. I know it's easy to talk about a bear case. I know it seems like all these things are wrong and all these things are questionable and uncertain. But if there's no confirmation to be a bear, you're just calling the top, and you know how long that can take. I mean, I'm talking about being wrong about 30 days, and that's exhausting. Let alone if I was long and positioning a fund to be short, like literally just having a bear fund and all my bias was pointed bearish. That would be exhausting and wrong and costly. So I'm just not looking to be short right now. Doesn't mean that I'm crazy bullish. I'm really just trying to collect some income. That's why I did a bunch of testing yesterday. Let me see if I can show you. I mean, I did a bunch of strategies yesterday. So just for fun, I ran all these tests yesterday. So if I show this here, strategy on the SPY, the Qs, the Apple's an underlined, Google underlined, Tesla underlined, SPX, NDX with spreads, the Dow and the IWM, NVIDIA, Microsoft, Netflix, Amazon, Facebook, before it turned to Meta, right? I did a bunch of those tests yesterday. So just one of my core strategies. And I mean, to me, it's like, yeah, I will keep doing what I'm doing. There's a stop loss. There's no ownership. There's income. Average trade is 30 to 40 days. I mean, it's pretty nice. So anyway, that's what I see in the US 30. Okay, so I see a bit of an ascending wedge, which means we're peppering these highs at 40,000. If that keeps getting tested, we want to look for a break, right? And what I'm saying is I'm wondering if the market is needing or getting another catalyst to break it higher. So if we take a look at the SPX, for example, okay, SPX, one thing that concerns me on the technicals is we are overbought. That's what this connected line is here. We had this nice run, and just to show how long this can last, we were overbought, we were overbought, we were overbought, we were overbought with divergence, right? The entire way up from that big rip we had here in October all the way through March. This was just crazy overbought. And so because it kept stretching, I was starting to get bearish. As soon as we had this gap, I'm like, okay, we're going to come back and fill the gap. Nope. Okay, we're going to come back and fill the gap. Nope. So there was a period here that I was losing on the put side, but fortunately trading both directions. So I was long on the call side, and it made me money. I could have made more money if I just stayed long, but sometimes you never know. You're just going to get some volatility, right? So anyway, I would like to see a bit of a pullback. Okay. And by pullback, I mean something here. We test this level. Okay. We maybe poke up a little bit to 550 or so, or 5,500 again and stall. But I would just like to see this. I mean, we had an April correction. June, July historically are bullish. By the way, the next 2 weeks in trading, the next 2 weeks historically in the markets are the most bullish. I don't know why. Maybe it's because it's summer trading. Maybe it's because it's low volume. We are ending the quarter. We are kicking off Q1. We have a holiday next week on Thursday. The market's still open through Friday. Friday we have non-farm payroll. And I said this week. Non-farm payroll is either going to be a move like nobody's watching because it's a summer holiday, or it's going to be a dud because nobody's trading. And right now, they're all the short interest is kind of evaporated. Everyone's just kind of accepted that the market's in a drift. One thing, I listened to this content yesterday from Tasty Trade. One of their analysts made a pretty good point. I mean, if you are a passive investor, we talk about markets every single day. So I mean, we're in the trenches, and we're always looking for like this could happen, this could happen. What are we going to do? The reality is, if people out there are passive investors, okay, people out there that are passive investors haven't seen new highs in their accounts since January of 2022. And so just recently, literally this year, this was the last time they had an all-time high in their account, right? If you're a passive investor, so think about, all the 401ks and all the, financial advisors that have just been like, oh, the market's back in a bull market. Oh my gosh, it's so awesome. Okay, they look like geniuses. They're not. They're just letting the market do its thing. But this was the previous all-time high. Traders, investors, passive investors were sitting through a drawdown for 2 years in order for us to finally eclipse those highs. Now, it's nice to see that we are sitting at all-time highs, but like I said, just a little bit of caution. We're sitting here at all-time highs with some overstressed conditions. If we have a pullback, great. Maybe it offers up a dip. If we're still continuing to kind of blow this top off and we stretch higher, technically there's room for this thing to get up to 6,000. I've mentioned that. I don't think it's that far-fetched. And truthfully, I think the market is more of a destination right now than it is intraday. So I'm way more interested in the next 3 to 6 months. Are we higher or lower? And position for that, as opposed to what are we doing today? Just my thoughts. I think it's way easier to look out farther than it is to be trading, today. Um, if I were to trade today, then I would be solely focused on zero DTE, and I'd be solely focused on futures trading. I'd be solely focused on inverse ETFs and all this other stuff that's, hedging it. I mean, I do that. I have a lot of collar positions on my own stocks. If I want to take a bearish trade, I can, but I like to do a lot of kind of omnidirectional trades. I like to do a lot of hedge strategies where as long as I eke out profits, I make money. So doesn't have to be challenging. But if you look out farther, I guess you need to ask your question now until the end of the year. Are the US markets going to be higher or lower? We have a lot of stuff pointed towards they like to go higher. Historically speaking, there's a 54% bullish bias baked into these markets. You're talking about right now, this entire market has been led by very few stocks, and it's still pushing all-time highs. So the one big catalyst that's under the surface is if we start to see a broader market movement, that's a good thing for everything, right? Nvidia can take a back seat, right? Apple can slow down, Microsoft can slow down. Maybe there's other sectors that will pick up the slack. What those sectors are, I don't know. Are they going to be, consumer retail? Are they going to be other communication services? Are they going to be something that's more defensive, like consumer staples or energy or utilities? I don't know. But if the broader market picks things up, then that can help, support the top 3 stocks that have been carrying us for the last couple of months on the SPY, on the Qs, on the S&P, on the NASDAQ, right? That market cap weight, because it's heavy concentrated, and, it's concerning, but you have to give the broader market a chance to catch up. And if it does catch up, great. We're going to all-time highs again. And that's not just the US 30, that's not just the Dow, that's not just the SPY. The one trade that I keep looking at that I'm really curious on is the Russell. Okay? The Russell, if you go IWX, this is going to be a Russell 200, which we're sitting here at all-time highs. If you go to the Russell 2000, we're sitting here in this indecisive zone that still hasn't really turned bearish, right? But if we stay here, same type of pattern as the US 30. If we test the high, test the high, test the high, we're making higher lows. If we breach this level, this is probably one of my favorite index trades for the rest of the year. If we see a nice clean break on the Russell above 210, this is IWM, I think this run to 240, 250 could be pretty exciting. That would maybe be one of the bigger index moves that we could trade. And obviously, we could see the SPY and the Qs blow off tops again, but you're talking about maybe a 15% move in an index. That's pretty exciting, right? When we had a broad market rally from October to March, the Russell actually outperformed its counterparts. But it is small cap. All you're really looking to do here is maybe close the gap between large cap outperforming small cap. If you've seen that chart, we're at one of the highest, inequalities or disparities between large cap and small cap since like 1999. So it's a big deal. Doesn't mean that it always has to historically close it, but there's room to catch up is my point. Okay. Game City says, can you guide me where to start learning option trading? I'm trading options. Sure. I mean, I hopefully I can guide you a little bit. If you come to my YouTube channel, youtube.com/Chris Pulver, I do have some good starter videos. So if you look in my video section here, you can search for options 101. There you go. So long call options, long put options, credit spreads, covered calls, turn winners into losers, own stocks for free, strangles and straddles. That's a good way to get started in options trading. Obviously, when I'm in this session with A1, and if Frank joins me, or I'm talking options quite a bit. Why? Because it's an easier. To me, options is a fair asset for anybody to learn how to trade. It allows you to trade leverage in an equities market. If you have a margin account, you're getting 2-to-1. If you have a cash account, you're getting 1-to-1. But you can utilize leverage, put up way less cash, and be trading both sides of everything. Carve out profits with strategies that are single direction, both directions. Just trade what the market does over and over again, and everything becomes very mechanical. I love options for that. If I can carve out a strategy that is a 55-60% winner, I make bigger winners than I lose. I make money. If I carve a strategy that's 80 to 85% winners, 90% winners, it builds a lot of confidence in what you do. It's a process, right? Control the risk, manage the profits, redeploy your capital. It's very mathematical, very probabilistic. So that's a good place to get started. Okay, this is my YouTube channel, youtube.com/Chris Pulver. And if you search my video list, which I have, I don't know, 500 videos, almost 497 videos. So there's a few in there that'll help. But if you want to go specifically at options, check out those options 101s. And give me some feedback on the videos. Let me know. If you want some more information, just shoot me a message. Okay, US 30, run through it again. I feel like Vince Vaughn in Wedding Crashers. Okay, all right, I'll make you a balloon. All right, all I was saying on the US 30 is, to me, this looks like an ascending wedge, which is this. The bulls have topped out here around 40,000 on the Dow, okay, the US 30. We're making higher lows. I could see this market still testing. Now, all this means for me in this summer drift is, could this go both directions? Sure, it could go either way. But based on the structure of this bull charge leading the way and this momentum from low to high, usually an ascending wedge is what got us there is going to have the momentum going forward. So this, to me, would be what I'm thinking happens next. We find a way to justify going higher. And to me, this is broader market. This would be, non-farm payroll. And again, I think the U.S. is in a bit of a delicate situation with some of the job numbers. Is, yes, we've seen unemployment rise. We've seen non-farm numbers come in steady, but not gangbusters. And you have to wonder, if unemployment continues to trickle higher, there's a pretty staggering stat. Like, if you've seen a 1% move from unemployment in a 12-month rolling period, that's usually a pretty good sign of a recession. So could we have a odd soft recession? Maybe. Some people have sworn they've been in recession since 2022. But anyway, what I see on the chart here is we're making higher lows. We have equal highs here at 40K. That's where I'm looking to see if the top can get blown off a little bit and this can stretch higher. If that's a broad market move, then we're looking for everything else to go as well. So the one thing we keep seeing here, I could see a pullback happening on the SPX. And maybe not. I mean, honestly, look, it's friggin' June, July. Maybe the best we get is the market just does this. Maybe just goes sideways. Maybe for once in 4 years, the market wants to stall and go sideways. We have had nothing but trends, up or down, since 2020. Actually, go back further. We've been in trends since friggin' 2017. We have not seen a period of sideways movement or consolidation since 2017. Okay, this was 2017 ripping higher. Okay, 2018 was a correction. That was a Fed put. 2018 to 2019, Fed put. 2020 COVID crash, global economic crazy stimulus, debt fueled rally. 22 correction of deleveraging. 2023, Mag 7 led the way. AI started to be hype in the trigger words, and now 2024, it's all AI and it's all tech for right now. But we're going to see if the broad market can catch up like it did in 2023. We had 2 broad market rallies in 2023. It was in May and it was in November. And here we are now. It's just the best of the best, the creme de la creme, the cream of the crop, the top 3. And you wonder, is the broad market going to step up and pick up the slack? Okay. All right. Let's talk some other instruments. So like I said, index wise, US 30, I'm looking for that ascending wedge. SPX, NDX, SPY or Qs, I'm looking for a bit of a pullback just because we're overextended on the daily charts and weekly charts. I would like to see it pull back, fill maybe the CPI gap from a couple weeks ago, but we have not had a 2% pullback on the SPY in over 300 trading days. A 2% pullback in a day, right? We've had pullbacks. We had a 6, 7, 8% correction in April. So don't get it twisted, right? We've had corrections. April is a correction. But in a single day, we haven't had a 2+% dip in a single day in over 300 trading days. So this market is heavily tilted bullish. Okay. Game City says, which broker can I use for options trading? Trading outside the US? That is a good question. Look, I know a lot of major US brokers will they do allow US or non-US traders. I would point you in the direction of, I mean, I work very closely with Tasty Trade. I love them as a broker. They've been great to me. Um, I mean, I would try to start with them if they can. I mean, I can do things with a Tasty Trade account with IRAs that I can't do anywhere else. I can trade futures, I can trade crypto, I can trade, obviously equities and options. I can do all sorts of strategies with them that you can't do anywhere else. So the permissions I get from Tasty are great. I would like to say start with them. If they can't service you as a non-US trader, then you can look specifically at what brokers are in your country that allow you to trade US equities. The difference would be is maybe you have leverage, maybe you don't. Maybe you have restrictions. I'm not sure, but I would say start with Tasty Trade if possible. Micron slumped. Do we have Micron miss earnings today? That's in the semiconductor space. How bad was it? Not bad. Not bad. We did a hypothetical on this one. I didn't take any earnings trades this week. I just didn't want to toss any money at it. The one that would have worked out really nicely was FedEx. We have Nike coming out after market today with earnings. Micron is from 142 to 135. If I was doing an in the money bear call spread, that was going to be my hypothetical trade, collecting a lot of credit up front, risking very little on the trade. It didn't move enough to have this trade be profitable. I mean, you're still risking a little bit on the trade, but not much. Anyway, all right, let's talk gold and silver. Contact you. Let me do this. So if anybody wants to get in touch with me, I am here every single day in my Discord channel. That's probably the best place to find me. Let me send you a link to that. So I'll send this for everybody. If you want to join my Discord, all are welcome. It's a free group chat. I'm here every single day posting. Okay. So now, again, quick disclaimer. If you join my Discord, it's not me sending private messages. That is the one thing that I will say I absolutely hate about Telegram and Discord and this service and this service. If you join my channel and you get a private message, it's not from me. And I cleanse my channel all the time from imposters. There's people that try to mimic my name and copy my name, and they get it like one letter off. Just come to the free group chat. That's the best place to find me. The free group chat. Okay, that's where I'm at. I don't want to send any private messages. If you want to message me, that's fine. But I'm not going to reach out to you personally. All right. I just keep it in the free group chat, keep it public, keep it transparent, as it should be. So anyway, here's a link if you want to join. Let's go invite link. I'll make this so it doesn't expire. And there's the link. So here is my Discord channel. There you go. The one-on-one videos just come to my channel here. So if I share this, I don't know if maybe this search will work for you. It's just my options 101 in my video playlist. So let me see if this works. Options 101. There you go. Okay. So see if that link works for the YouTube channel. This should just take you right here to my playlist. And there's a ton of videos. I mean, I do a lot of live sessions, but I have like 60 or 70 videos on just, timeless education, you name it, I try to knock. So anyway, all that. And anyone recommend a futures options broker besides Tasty Trade? You don't like to trade futures? Tradeovate is another good futures broker. I have a couple of friends that are on Tradeovate. That is TRADEOVATE. But if you are a futures trader, Tasty's pretty good. I don't know what the beef is with them. I got nothing. I trade futures with Tasty. They've been great. My commissions are low. The platform is easy to use. Tradeovate's another one that's pretty popular. A couple of friends I have that run future services, they use Tradeovate. So they're out there. But as with all, make sure you're using a regulated broker. Okay, be careful with the prop stuff. Just throwing it out there. I hate hearing the bad stories of, I made some money in my prop firm and I didn't get paid, or the prop firm is only using a demo account, or I don't know. So just do your homework, do your research, and make sure that your capital is safe. So if you have your real account, absolutely work with regulated brokers. If you ask me what forex broker to recommend, there's maybe 3 in the world that I recommend. I've been with Oanda for almost 10 years now. And I'd say Oanda for US. Tasty FX is now IGUS. So it used to be IGUS. Now it's Tasty FX. You can trade Forex in Tasty, but it's Tasty FX, which is great. I've been trading Forex since 2007. And 8cap is, if you're non-US, 8cap's my favorite broker. I was with Pepperstone for a while. Actually, some of the team at 8cap formerly was with Pepperstone. So 8cap's a great broker for non-US. You can also trade CFDs and other things. So Oanda is not trusted anymore. Okay. Well, I've had no problems with them. I've had disruptions with them, but I mean, they are super well regulated. So I don't know how you can say they're not trusted. IC market is so much better. I've never even heard of that. So anyway, do your homework. That's all I'm saying. I mean, I've had millions of dollars in Oanda. It's been fine. The one thing that has been annoying has been my robot trading getting disrupted by server changes and kind of things that I can't control, and that is super annoying as a trader. All I want to do is trade. I just want to focus on the process. I don't want my server disrupted. I don't want crap changed on me, and I want leverages changed. So that I don't like surprises. I just want to focus on trading, which is already hard enough. There you go. So IC Market says, yeah, so they're the best, but they're not allowing US clients. Well, then I guess I'm out. All right, Frank, what's up, dude?
Hey, Chris, how's it going?
You want to talk some brokers? Seems to be the direction today.
No.
No, okay, that's fine.
Not really.
Yeah, I'm good. So, like I said, do your homework. Regulated brokers. That's all that matters. And then focus on the process. Trading is trading. All right, dude. I'm sitting here watching the SPY, seeing if we get to 548 today. We're trading at 546.56. Big gamble level of 548. We almost got there this morning. We're at 547 and change. I've got a long SPY position. Frank, did you personally happen to nerd out at all with any of the look back software that I shared?
A little bit. I was
A little bit?
testing.
Okay.
I was just testing naked calls for 1 day out.
Okay.
And then wrote it to expiration, and I think I just put a 50 delta because I'm
Okay.
thinking about just buying right on the money and seeing what it would do throughout the day, and
Okay.
it actually was a losing strategy. But I think there was one where it was a call spread, and
Uh-huh.
I think they were 5 points uh, from the money. So there's 5 points in the money, and then you sell a call 5 points out of the money, and
Okay.
then did that for, I think I did 5 days, and I think that was a semi-winning strategy, but I don't
Okay.
know. I have to look at it again.
Gotcha. I'm gonna play around with something right here. 15%. So maybe the quick profits, 30 days. 30 days. So I had a pretty interesting test right here. If you see my screen, this is basically I call this it's kind of a split spread, which means if I win into every week with this trade, where all I'm doing is I'm buying a call at a 70 delta and I'm selling a call at a 30 delta, I'm going after a 15% take profit of what I paid for it. That did really well over the course of I don't let me check my spreadsheet here. I think the start date was not 2006. It might have been just slightly after that, but let me check this out. This is the 5-day, 10-day. So let me see when this first date started trading. So this started up. It started January 11, 2006. Okay. So this racked up about $32,000 in profit. Percentage wise, we had about a 77% win rate. Now, what's kind of nice about this is you go into 2006. Let's say you started trading there. You had a terrible market in 2007, late in the year, Q4. 2008 was abysmal, pretty much the entire year. 2009, we didn't bottom until September 2009, and then we've had a nice bull market. We've had some pullbacks, here and there. 2011 was a downgrade. 2014 was an oil crisis. 2015, 16 was sideways. 2017 breakout. 2018 pullback. 2019 rip up to all-time highs. COVID break in 2020. Deleveraging 2022. Point is, this is a single directional trade. If all I did was had a slight bullish tilt to my trades, carving out these little tiny profits and wins, you see there's a lot of trades. You're examining over 1,400 trades. And I mean, yeah, I get $30,000 over a 17, 18-year period. It's not that exciting, but it's a one directional trade. I had some pretty good strategies yesterday. I was running 95, 96% win rate, 99% win rate on some of the underlines. Didn't own a single stock, used stop losses, carved out some profits, and generated about a 7.5% return annualized. So anyway, I mean, I went deep on this yesterday, and that's pretty much all I did for several hours was run a bunch of tests to save me a ton of time. So I still have some more to test today.
Did you put in Google Sheets?
I built it. Yeah. So I save them on, I've got some sheets in the background. Yeah. So I'm building my own strategies here. So if you and I want to, talk about this, like I'll share, what I'm doing here. So this is one of my core strategies. So short-term leaps, and I've got to do some additional testing on this one. This is omni spreads and then a split spread. So I'm gonna do this in a couple different varieties, different underlines, and just see. And look, I've been trading this way for many years, but to go back to like 2006, 7, 8, get all that extra data, to me that is even more to like help me validate the strategy and understand that we've not had perfect markets, right? We've had pullbacks, we've had bear markets, we've had sideways markets, but I'm just looking to see this just by mechanics. What's the edge, right? What's my probability? What's my win? If I make money, it just helps me build confidence that this trade over the long run is going to work. And I know that we could have high volatility and low volatility. Obviously, I feel a little bit more comfortable if I can find, omnidirectional trades, which is I'm going both directions and carve out profits that way. But those also, if you did that, like let's just talk about like the strangle for a second. If I were to, every instrument that I traded, if price is right here, okay, and I sell a call and I sell a put, and I did that every single time. Well, most of the time, okay, price stays within an expected range and strangles are great. You make money because you're selling this call, you make money because you're selling this put. But what I don't like is this bullish bias that the market tends to have, this positive drift that the market tends to have. It actually makes this about a 30 to 40% probability that this gets tested. Okay. This is like a 15 to 20% probability of getting tested. If you wanted the highest probability profit, just stick with the bullish bias. Stay out of the way. Let the market positively drift higher. So I know you can collect more premium up here, but if I'm getting this tested all the time and I've got to move and repair and get out of the way, I hate doing that because essentially it's going to force me to close out for a loss and then reposition and then try to get a win. So this is a win, but this can be tested. I mean, again, it's not high probability, like, okay, 30% of the time. Well, most of the time it's not getting tested, but when it does, I hate it. I don't want it to get tested. So I'd rather, collect a little bit less income on the sell side as an option trader, but trade higher probabilities and just trade more underlines. That's my approach at least. So anyway,
selling more puts as opposed
yes,
to selling one put, one call, and trying to
correct,
strangle it.
correct. Yep. And I've looked at strangles on all these underlines, on futures, on indexes, and they're great until they're tested, and then
Oh, yeah. Something I forgot to
right.
tell you this week. The only trade that worked out for me, I had calls which were
Mm-hmm.
1 day out and puts too, and they
Okay.
just expired worthless. But the
Okay.
only trade that worked out was that synthetic strangle that you were talking about. I did on the
Yes.
SPX,
Okay.
and price had some wild moves intraday, but honestly, each day it kind of comes back to break even or close. So
Yeah.
it never moved enough. And so those options were worthless as well, but I was on the sell side, so I collected the premium,
Yep.
which was nice. But it seems to be that unless you're trading intraday, if you want to buy a call either 1 day out or 0 DTE, they end up moving really fast in your favor if you're looking at a chart and just trying to scalp. But
Hmm.
the odds of it continuing in one direction is pretty bad. So um, I think they can work out, but if you're fine day trading, or if your broker will allow it, I think it's a viable option for this current market right now. But if you're um, if you're in it for like a whole day or for 2 whole days, you kind of have to expect that your option's going to be worthless. So doing that uh, iron condor trade, but instead of hoping on volatility, betting on the
Nothing
low,
happening.
yeah,
Yeah.
on no price action at the end of the day.
Yep.
That was the best play.
Yep. And so this is the trade this morning. I centered it around 54.80, and I went up to. So if I'm going to do this, like basically it's a strangle. I call it synthetic because I'm still going to spread it because I don't have, for one account I'm not putting $500,000 at risk. With a naked strangle on the SPX, but you collect a lot of credit up front if you do $20 wide on the spread. So like I said, it was at 54.80 this morning. I went to the 55.05. So I did 25 points up above, and I did 25 points, actually 20 points down below, because I essentially did it delta neutral. I did a 15 delta roughly. So it was like a 13 or 15 delta. And then I did 20 points wide in the spread. So it was a 55.05 on the upside, a 54.60 on the downside. That was trading at 345 this morning. 935, 940 this morning. The credit collected was 345. It's already up 80 cents. Okay. Now, if you do the math on that, what's 80 cents divided by the credit that you took? So we'll go 280. So 345, let's say minus 60 cents, or divided by 60 cents rather. So 3.45 divided by 0.60. You're collecting, come on, 0.6 divided by 3.75. You're collecting about 16% profit already. 15% is what I'm looking for on these trades. So profit's already been hit. I needed a debit around 290, 295. Grab your, 45, 50 bucks. It's a win. That is now 9 out of 10 trades in the last 2 weeks. So 1, 2, 3, 4, 5, 6, 7, 8, 9 out of 10 trades with this intraday SPX.
Nice.
So it works. And again, it's 1041. So this strategy it's not like something you sit on all day, and I'm not interested in recentering and starting this trade again. I think that's a little greedy to take the trade and be like, okay, I took my 15%, now I redo it. It does show in the long run. I mean, Tasty did a great study of this for like 0DT SPX for over a year. It did show that recentering and like taking your profit recentering does make you more money. Problem is, still brings you into risk. And if you have to wait till the end of the day, there's a lot more gamma risk at the end of the day. So I look at it this way. If the trade works and you're done trading in, an hour and a half, and you grab 45, 50 bucks, it adds up, man. It adds up fast. Throw an extra 200-300 bucks in your account every week. It takes about $1,500 to $1,600, $1,700 of buying power. It's a really good strategy. So anyway, it's fun.
Yeah.
I've been tracking it. It's proving pretty worthwhile, lucrative. But also in a way for the traders that like to trade every single day, it gives you something to do. Not that that's a reason to trade. It certainly is not. But it's a viable strategy for at least some daily income. And I know a lot of traders they find that appealing. So good stuff.
I want to ask you another thing, a
Okay.
couple questions.
Okay.
So Micron had earnings
Yes, they
last
did.
night,
Yes, they
and
did.
they blew it out of the water. And they have,
Oh, I would not have guessed
yeah,
that by the price action.
so they have also their 2025 orders, their sales, were basically booked. They're sold out for the next like year, meaning like they have they have their next earnings reports covered like through 2025.
Hmm.
So I'm wondering, why did it fall today? And what do you think of this Nvidia play overall? Because this is a big I guess this is big news for the chip companies.
Yeah.
Um, what do you think is like, I guess, a viable option for Nvidia? Because this has not moved all week. It had this dip Monday, then came back up and has not, like, I guess, completed this move. So I'm wondering what do you think of this, and why is it not moving, and why is the market still trending higher even if it's not um, you know, moving that
If it,
much?
well, I do think there's a realistic amount of rotation happening out of Nvidia into other stocks. I mean, if we look at the let's take a look at the heat map for the week. If we go to let me go FinViz. Let's look at this week's performance. I go back to simply Wall Street. So this was Micron. I mean, Nvidia is facing the same thing. Look, there's a lot of profits being made and a lot of profits being taken in some of these semiconductors and chip stocks. It's crazy. Like Nvidia has made millionaires, probably billionaires for a lot of people. Nvidia has been single-handedly the biggest contributor to the S&P's gains this year. I mean, I want to say close to 30+% of the gains this year have been because of Nvidia, and you throw in Apple and Microsoft, that's essentially the entire gain this year. I would say that majority of your gains this year to lead to a 15-16% start at this point of the year, most of that, not I guess not most of it, but like 30 to 40% of the gains have been
So you're
because
saying
of
the volatility is going to be low for Nvidia now?
no, not at all. I mean, I think Nvidia. Look, it's going to be. I hope that it's just not. I hope it's not crazy volatile because it's like number one, two, and three in the world. I mean, if you take a stock that's pushing three plus $1 trillion in market cap and you make it trade like, it's up to 140, it's down to 118, it's up to 150, it's down to 100. If it's crashing to 70 or $80, it is going to wreak havoc on everyone's like holdings, right? It's way too influential now because it's so large. So if there's rotation out of it, I could just see a pause, right? I could see maybe people are peeling back. I read something about like a tech fund that was going to do a heavy amount of weighting in Nvidia. They were basically going like 20% holdings in Nvidia, and they swapped it out with like Apple and a few others. So it's, I mean, for a firm that's like we're all in Nvidia, okay, great, but that also could bite you in the butt if there's a lot of volatility ahead. If there's a lot of profit taking, and Nvidia has what I think is a necessary correction, and also record amounts of inside selling. Same thing I see here. This is the only risk that I see here for Micron. Right, earnings forecast to grow 80% a year. Okay, it's all these chip stocks. By the way, these semiconductors are probably trading overvalued, more than likely. Okay, current price is 142 on Micron. The fair value is $40. Okay. Nvidia is the same thing. They're overvalued. You're paying for this future performance and this future guidance, which in a way it's justified. But if you look at what's happening outside of Nvidia, look, you've got Tesla that's getting into the semiconductor space. You've got Apple that's getting into the semiconductor space. These are technologies in disruptors that if they're grabbing onto something in this space, I ask you this: do you think that Apple has the capability to make a chip that performs better than what Nvidia has at market right now? Yes or no?
No.
No, you don't think Apple's going to make a better chip than what Nvidia has?
No,
Is
I don't think
Nvidia that
so.
is Nvidia that cutting edge? I just think Nvidia is in a position where they have a head start. Tesla is trying to make chips, or they're using chips now that are better performing than Nvidia.
Um,
So competition, right?
I
It's like Nvidia
It
has a
is
head start, but there's
competition.
competition. Yeah,
I didn't hear about Tesla making better chips than Nvidia,
yeah.
but um, I don't know. What I see is, for Nvidia, all the analysts on CNBC, no one says anything bad. They're all just talking it up. I'm not really sure why, and even despite its run up, it looks super overvalued. Except um, they say the EPS is only like 40 something, and or forward EPS is 40 something, whereas Cisco's was 196 back in the dot-com bubble. So
Right.
it's a completely different story. So Nvidia is still undervalued according to them,
Mhm.
and that it can still run substantially until you see
Sure.
any signs of being overvalued. But
Sure.
I don't know how. So what was its forward EPS then back when it was, say, below $100, like 6 months ago or something?
I have no idea. I have no
That
idea.
that's what's confusing. Was it just such a cheap company back then based on
Possibly.
its
I mean, the last 20 years, Nvidia, I think the last 15 years, Nvidia's been like one of the top performing stocks, but really that ballooned and exponentially gained in the last like 3 or 4 years. Nvidia just kind of came out of nowhere, but because it's had such drastic gains in the last 3, 4, 5 years, it's now immersed itself, or I'm sorry, emerged rather as one of the top performing stocks ever. Like it actually challenged. I mean, everyone said like, "Oh, Bitcoin's the greatest asset ever." Well, Nvidia put it to the test because if you take that track record of X amount of years back, the last 5 years, Nvidia's number one. Last 10 years, Nvidia's number one. I want to see him go back over 15 years, Nvidia's number one. But a lot of those gains happened within the last 3, 4 years because it's been exponential. I mean, Frank, it became the number one market cap in the world out of what? Out of nowhere. I mean, dude, I remember last year I was looking at Nvidia at $400 thinking like, okay, I want to short this now. At $500, I think I want to short this now. Once I got burned twice on that, I'm like, I'm just not going to short Nvidia. That was easy. That was the easiest decision ever, just to get out of my way, let the thing blow through the highs. So, I mean, to your question, look, I think that there's decent amounts of rotation. What I find interesting right here on this heat map is this is going back for the last week's performance. Nvidia's down, AVGO's down, Qualcomm's down, Micron's down. So be it. Semiconductors, freaking good. There's other stuff out there to trade. This is Intuit. This is Salesforce.
Salesforce?
We got Apple. Okay, you got Microsoft, Apple. So Nvidia, number one in the world, shed $300 of market cap. What's Microsoft? Number one in the world. It's up 2.2%. Apple, second, third in the world. It's up 1.96%. These are still keeping everything as is. That's why the market's not dipping and dropping. Google, no slouch, right? Google's up 5%. Amazon had big news with Rivian yesterday. It's up to fresh highs. I mean, I'm long. I've got some great trades running on Amazon. I got like a 160 call on Amazon that's currently up like $40. So yeah, I'm like, there's other stuff out there to trade, and I mean, Meta's up there. Netflix is creeping up the new highs. Tesla's ripping up here. There's a lot of good stuff happening. So there's enough elsewhere to not just be like, oh, it's all semiconductors or bust. It's not. So Nvidia, look, I'm happy that a stock that's that big and that influential can have a 5% pullback and still not tank the friggin' market. I mean, if you think about it, Nvidia was down almost 20%, and we still had less than a 2% dip in the market this last week, right? I mean, what's our let's go back to the SPX here. Oops. Let's go back to SPX. If we go back to the SPX and we go from this recent high when we tapped out at 5,500, what's our pullback?
It was
So from this,
1%.
yeah, you're talking exactly 1%. And the largest company in the world almost had a 20% pullback. So thankfully, there's other stuff to kind of help stabilize the market. And that is why people will probably argue this, as they should. I heard this saying, I never heard this one. I don't want to mess it up. If though, I'll figure it out. It was something
While
like,
you think of
if you
that,
die, if you die, whoever has the most SPY, I don't know what it is. I'm gonna butcher it, but something where it's like basically just if you own the SPY and you have the most SPY, you win. Something like that.
well,
Because it's been true.
when
Like it doesn't matter how long you look back, this market found a way to get through a lot of crap.
but
So
even to that point, you even said earlier, NVIDIA was a contributor to most of the S&P's gains.
it was.
So,
Yeah.
and that was this year was what we're talking about.
Yep.
So, um, if NVIDIA sees a harsh pullback, say
Hmm.
it gives back everything from this year, would that
Sure.
not? I feel like all of the gains that the S&P made as a result of NVIDIA, the S&P would correct just as much.
I disagree. I just as much. You think Nvidia has a 50% pullback and the stock market is going to dip the same amount? No way, dude.
No, I'm saying that,
But you're saying
say,
like contributor wise that it would give back some of those Nvidia gains is what you're saying?
yeah, they won't move the same percentage wise, but
Right.
S&P moved up however much percent this year. It's less than
About
Nvidia.
15. Yeah, it's like 15, 16%. So
So I'm saying if
proportionally is what you're
Nvidia,
saying.
yeah, if Nvidia crashed 50%, then that would be like a 7-8%
Sure.
correction on the S&P.
Yeah, and it's look, it's true, right? But you have to remember that it's it's Nvidia's an influencer, but if there's right now rotation out of Nvidia for whatever reason, insider selling, tactical management, rebalancing portfolios. I mean, look, quarterly, monthly, rebalancing happens all over the world. If you are if you're getting all these gains from Nvidia and you want to rebalance to a more like balanced portfolio, then you dump Nvidia or rebalance it so it's no longer a huge portion of your gains. And so if Nvidia for your portfolio is a, let's say a 1% stake, well, now your gains have given you most of your gains this year all because of Nvidia. Well, you just scale it back to have a 1% balance again, whatever that looks like. And so it's not as influenced by Nvidia's pullbacks. And so there could be a full on rotation away from semiconductors because they've had a good run. I would say if you're a smart tactical asset trader or tactical management trader, you get out of what's overvalued and you get into what's fair value or undervalued. That is rebalancing. That happens all the time. It's going to, I mean, it should be happening with funds. It should be happening with institutional money. It should be happening with financial advisors in some capacity. Get out of
So the
what's,
consensus,
bloated and
the
get into stuff
consensus
that's
is
that's valued.
that it's overvalued. Um, so that's the confusing part because no one says it's overvalued.
I agree, but you can say it's not overvalued, but also, what stock in the history of stocks always goes up and never comes down?
What
None.
stock in the I mean,
None. They
none.
all come they all come down. And if you have a stock that goes up exponentially with no sign of stopping, that usually does not end with just, oh, it just paused for a little bit. I mean, this is as crazy of a run as we've seen in years, but when it is up, and I think we did this on, Monday maybe, or Tuesday. If this is a 1, 2, 3, 4, 5, from a technical standpoint, all I'm looking for is Nvidia just to come down and just have a little freaking breather, and then we'll see if this is going to resume, right? If it pulls back and tests a 50-period moving average, or it comes back and tests a trend line, or it comes back and tests a pocket or demand anywhere that is just reality, then sure, we can resume the uptrend. But I've never ever seen a chart that goes up and has never pulled back or never come back down. Now, it may not come all the way back down. That's insane. That would be a horrible instrument to trade, right? That's pretty much Bitcoin minus maybe about 20% of that. But if you go up like this, you're going to have a pullback. You go up like this, you're probably going to have a pullback. I mean, good example would be Cocoa Futures. Is that CC? Yeah. Even this that could do no wrong was up, 1,000% or 400%. What was that? That was a rip of over 200%, almost 200%. It pulled back. You could do no wrong in Cocoa. It doesn't matter, dude. It's like it doesn't matter what the instrument is. Nothing in these markets, if there is supply and demand and there's liquidity, nothing goes up forever. Nvidia has had a heck of a run, one of the best we've seen in a long time. People should be lucky that the market latched on to AI and latched on to Mag 7 and latched on to tech, because it seems like without it, this market would be trash. If it wasn't for the Mag 7, we wouldn't have survived 2022 after a pullback, right? 2023 came out swinging with like tech recovery. Okay, then it became about the concentration of Mag 7. Mag 7 became too overweight. Then it became the Mag 4. Then it became the Fab 3. Okay, it's like all we're looking at is somehow this market keeps justifying higher highs. And I don't know all the intricacies in it, but I would know that if I look back for 70, 80 years, we've survived wars, recessions, high and low volatility periods. It still finds a way to go higher. So, that's my bias. That's my bullish bias. I like pullbacks. I want to see dips. I want to see corrections because I want to buy things cheaper. but NVIDIA is not like the end all be all. I mean, honestly, Frank, if I never traded NVIDIA for the next 10 years, like I don't really care because there's other stuff I can trade. But it does feel like NVIDIA is just the classic FOMO. What do you do that it's pulling back? What's it going to do? Is it going to crash the whole market? No. It's like it's just a stock, dude. So I feel
Yeah,
like
no,
I think NVIDIA is good, but it's not. I mean, nobody needs to hold 100% NVIDIA. I
it
mean,
wouldn't crash the market. It's just if it
no, but it's
contributes
gonna
to
it's
a
gonna weigh
large
on it.
percentage. Yeah,
Yeah,
it's
it'll weigh on it.
gotta. And so I guess the fact that Nvidia hasn't moved, and then you have the other Fab 3 stocks pushing higher,
Sure.
that's what's gonna carry us. But okay, so the one day in this week, I think it was Monday, when everything was down except for the Dow,
Yeah.
that was the start of this sort of rotation. Or
Agree.
what do you think? Is it are we moving away from, I guess, these large cap tech stocks and
I
going
mean,
into stuff like staples?
well, I don't know if we're going that defensive, but let's look at the broad market right here. So right now, at a glance, we are showing that we're having a lot of stocks that are kind of split right on, and this is an important spot. Let me see if I can get. I wish I could customize this. So we have about 61% of the stock market advancing. That's market breadth. That's a good thing. We have about 61% making new highs. That's a good thing. We are 50-50 right now. So 49% is sitting above the 50 period moving average and 51% below. This is going to be a really good indicator. Let me change the color here. This would be a good indicator to see. So this is broad market. This is market breadth. That's good. This is market breadth. That's good. If we start to see that this gets, let's say, greater than 51%, and we're back above the 50, that means that what we just had here, Frank, is we had stocks that were in a buy zone. So that means that let's say this is the 200. Okay. And then we had a 50 period. What this shows is that if we start to see this SMA 50 advance, that means that stocks that have had a correction that are in between the 50 and the 200, if they get back above this, that is a bottom and a resumption of an uptrend because we're still in a buy zone. Look at this, 62%, 62.5% are greater than the 200 moving average. So we're still in a buy zone broad market. Getting a dip below the 50, great. But if we get back above the 50, that's a classic pullback technical indicator. We dip below the 50, we close back above it. We're still in a buy zone overall, resuming the uptrend. You're looking for some market breadth. That I think is a good thing. That's a healthy sign of the overall market that can stabilize. Like it's not just top 3 friggin' stocks. It's probably the stuff that's been underperforming or the things that are actually available at fair market where there's a rotation into that. So is it rotation into more ETFs? Maybe. Look, if the broad market rallies, does the S&P typically gain? If you had like 40, 50, 60, 70% of the stocks advancing, let's say 50 to 60% advancing, S&P is going to go higher, right? The NASDAQ, if you got 100 stocks, and you have 67% of those advancing, Qs are going to go higher. Like collectively, I mean, it's not all NVIDIA. It's not all, 3, but it's high concentration. But even at the highest concentration that we've seen in like 30 years, it's only 21% of the S&P, right? So you still have
Yeah,
80% of the stocks that can still make up and step up and friggin' move. So there's still a big portion that's just, if it just performs okay, but it's broad market up. It can be a melt up. It can be a low drift, but as long as nothing is crashing, you still have 80% weighted out there with all these other stocks with, basically 495 stocks. You can have the broader market still lift and carry the torch in place of this, yes, we were carried a long ways and probably overstretched by the Mag 7 and the Fab 3, but now it's time for maybe the broader market to step up and see what is undervalued to maybe have a chance to run. So I mean, right now it's like I am interested to see if the Dow plays catch up. I wonder if the Dow is gonna pick up the slack and maybe get back up to these highs at 40,000 again. So the Dow at 400 or the US 30 at 40,000. If we get back to 40,000, that's kind of exciting. It actually, because we had all-time highs. This was what was crazy, right? We had a big pullback on the Dow, but we had all-time highs in the Qs and the SPY. Well, if right now the Dow's catching back up and the SPY and the Qs are staying sideways, everything's kind of collectively near those highs again, and we see, can they keep going? The one thing that's still lagging behind would be your Russell. If you go to the Russell, we're still way off, right? I mean, we're 15, 16% from these highs. I'm curious, that would be the big catch up this year. That's 21%. If the Russell gains to all-time highs, the Russell 2000 as a broad market small cap index, if it goes higher, this is an index that has 21% upside just to revisit all-time highs.
Yeah,
Nobody
this is a
knows where
catch-up
all-time
play.
highs can go. This is a catch-up trade, exactly, right? And there's 2,000 stocks. It's not 100. It's not 30. It's not 500. It's 2,000 stocks, right? If you trade the VTI, the VTI is the total stock market globally. That's 3,000 stocks. It's at all-time highs. So there are things that are still moving, and it's not just three. So I guess our summarize the conversation, it would be something else can step up. And in this case, you have thousands of stocks that can step up a little bit. You have hundreds of stocks that can step up a little bit. And that's enough to say, okay, thank you, NVIDIA. Thank you, Microsoft. Thank you, Apple. We've got some other stocks that are able to perform. And maybe consensus-wise, margin-wise, fundamentally, they look okay. So I could see that, there's some rotation out of heavy concentration, maybe getting a little bit broader. You had mentioned staples or utilities or financials. There's certainly defensive stocks you can get into if you're worried. But I also think that it's going to underperform. If you get into defensive stuff now, I think it's going to underperform. I would say I'm way more cautious going into Q4 in November, December, because I think that's the make or break for this market. I think this bull market to be sustained, we have to have a good Q4. Because if the election is enough drama to bring the markets down, having a bad Q4 is going to put a real damper going into 2025. So for me, I'm looking at it this way. I think we have a good solid runway for this to drift, to stay sideways, to go higher through probably August, right? September historically is a down market because it's tax loss harvesting and it's a September effect post-summer. But usually, I mean, Frank, in the next 2 weeks, historically, it's the most bullish time in the market. The first 2 weeks of July are the most bullish in the market historically. Doesn't mean it has to be high volume. It's just but there's no bear usually in early July. So I think we can trade fairly bullish, fairly aggressively through end of July into August. Then I'm playing a lot more defense. I want to, obviously I'm as curious as everybody else, where's where price is going to be with the election. I don't know. If they're higher, cool. We survived drama. If we're lower, okay, I'm definitely playing defense and going into a bad Q4. Q1 of next year doesn't look great. Then we can start talking about getting some gains. We've had a good run, but man, reality could be a real pain in the butt, similar to 2022. We don't know. That's why I'm long the end, just in case.
That's definitely some interesting stuff.
Yeah.
I'm with you. I guess I don't have a bias right now because I am pretty bearish, but I'm not selling necessarily.
Yeah.
Because there's no point in selling against this trend. But yeah, we go into these next few weeks and we see more upside. Yeah, so what? We're gonna see the likelihood of seeing higher levels is very probable. But
Sure.
going forward, I think that the hype of what the Fed is gonna do is gonna carry us to the hype of that one interest rate cut. That's pretty. I don't agree with it, but I think it's going to be a political move. I think they're
Yep.
going to suggest that rates are coming down. It's better than ever, or this is the time to start looking at buying a house again and start spending more money and stuff like that.
Exactly. Yep.
It's not going to help us. It's just going to be a selfish move, I think, from a presidential.
I think it's optically what the consumer is needing and looking for. I think it's certainly even though the Fed is not supposed to be political, I think it is a political thing to allow the American people to feel that if you've been waiting because interest rates are too high and you're looking to get a house, Sure. One cut does not change that, right? I mean, if if we have a cut in September and I go to the bank and I'm like, okay, finally, I'd like to close on a house, and like your interest rate is 6.75%. You're like, oh wait, what? Yeah, because it was 7%. I mean, it's not that big of a deal.
Yeah,
And
it's not gonna be any better.
right.
It's
It's
just
just
a
like I said, it's the optics
heater.
of it can start. So and we go out to the end of the next year, we're only looking at if the Fed truly stays on some type of consistent cutting cycle, we're only looking at like a 1 to 1.5% cut cycle through the end of 2025. Now, what they still need to see is inflation trending lower. Now, again, as we know, 3.4% sticky is not nearly far enough or not nearly close enough to 2%. I mean, I think the Fed would love, especially to justify a rate cut. I think the Fed would love to start seeing year over year get under 3%. It's not under two, but if we were under 3%, I think that would say, okay, we can go from 5.25, 5.5 down 25 basis points. I
Right.
mean, restrictive wise, it's like if we're sitting 1.5 to 2% above, the actual like inflation rate. I mean, that's considered restrictive, but I think it's just so dumb. Like every month, dude, it's like, what's the Fed going to do? It's like probably nothing, right? The economy, and think about this: the economy isn't always running hot. I mean, usually we just have the economy humming along. Nothing. I mean, it's like we don't have 6, 7, 8% GDP. We have like 1 to 2% GDP. So even staying in that ballpark, it's like we're just humming along. I don't know what we expect. I think we just expect like, I mean, the US is never going to deliver China numbers where we had like 6, 7, 8% GDP every friggin' quarter. It's just not happening that way. China's been super quiet. I'm not bummed about some of the China plays, but like I am disappointed that there's no follow through. I looked at the HSI this morning. We have a pullback that since we had the top here in May, we have not come anywhere close. But again, I'm watching this closely because this low, this would be a double bottom pattern. If we go here, we go here. This is just up, hopefully a correction, and then maybe a little bit of global love. I still like China. I think that China right now is hated quite a bit as far as you can't invest in China. It's uninvestable. To me, it's a value play. It's asymmetrical, which is hard to find. And so, look, I'll trade with options. I could be wrong. I could take some heat, but it's all calculated risk. I mean, I've got maybe 3% exposure in China. But if I'm right on China, my 3% exposure could probably give me 8 to 10% of my portfolio, maybe more. I'm just trying to be patient, trying to give myself enough time to be right. So I do have some ownership. I've got some brackets and some collar trades, but right here, if we stabilize, I mean, this is Baidu, and I'm just waiting, man. I mean, maybe Baidu is going to be a double bottom at $80. Great. Well, I'm going to take some stabs at it, Frank. I'll be down here. I'll take some stabs at it. If I'm right, $80 to 160. I don't know a lot of stocks right now or a lot of indexes I can look at that are going to offer me 100% that looks pretty good, right? This
Right.
play looks good. It's just a trade. If I put, 2% on this trade and I can make 4%, great. How do I do that? By having a little bit of leverage with options and, playing it out long enough. So anyway, there's good trades. I'm still liking the diversification that I have, but I'm as curious as everybody else what happens next. If you and I knew what was going to happen, then guess where all of our money's going to be and what happens next. Russ is asking me, are buying the yen now? I am, but I'm not buying it in currencies. I'm not trading forex with the yen crosses. I took a tiny trade today in the Swiss yen. It's nothing, right? The Swiss yen, I took a stab at today, 179 or 178.98. I took a stab. I put a stop loss at 180.50. But the way I am actually starting to participate in a little bit of Japanese yen is this index. This is a ETF that trades Japanese yen. This is the FXY. I bought this at $58.60. So I'm down about $1. Big deal. I'm going to start dipping my toe in this trade right here. And sure, if the dollar yen rips to 165 or 170, I'm going to be in a drawdown. But my, let's say, $500 to $1,000 drawdown is way more manageable than being down 500 to 1,000 pips in a Forex account unless I'm trading it super, super small. So I can test the waters here. I'm not getting charged negative swap. So I'm going to start dipping right now in the Japanese yen with FXY. And that way I can trade this. I can also trade it with options. So anyway, that's how I'm doing it. Am I bullish Japanese yen in the short term? Not really. I hate the yen. I said it yesterday on the show. I absolutely hate the yen. It is one of the dumbest currency pairs and baskets to trade because it doesn't respond technically the way you think it should, and that drives me crazy. If you want to trade the yen, never fight what you see. If you see a trend, stay with the trend. Wait for a confirmation break to give you a reversal pattern, then you trade it. If you want to trade early in the yen, there are victims for decades of how many people have been killed by the yen. And natural gas is supposed to be the widowmaker. Well, if you're a forex trader, the Japanese yen is, the make or break. So it's never good. Frank, you trade in the yen? Do you care about the
No,
yen?
I
No.
don't trust BOJ because I've traded
Excellent
currencies
point.
in the past,
Yep.
but I don't follow currencies as much as I do now just because of what's going on in America with brokerage accounts getting canceled. I had two funded accounts where you had to pass
Yep.
to get the funds,
Yep.
and they said that they're no longer doing US clients. So
Yep.
it's
I know. It's all a bunch of garbage, man. I mean, and we talked about brokers earlier. It's like I said, just be careful on the prop stuff. I mean, the nice thing about prop stuff is it's not necessarily your money, but when you're paying to play to get into the prop firm, you're paying to play to get access to those accounts, whatever it is, 10, 20, $50,000, you're putting in money. You're trying to trade and show like, hey, I can, keep a profit, and then you want to get paid on those profits. But yeah, I know
well,
it was a big
the
disruption.
validity of those prop firms. I I started getting I started getting very speculative of because there was one time I think I took a total of 7 tests. I passed 2 of them, and
Okay.
one of them, uh, when it basically canceled the account, I was still able to trade. So it was like a demo account I was trading on, which is
Okay.
weird because if it's real money, it's supposed to be real money, the like real funds you're trading with. So it
Right.
seemed that they were, I guess they could be collecting funds through everyone's purchase of a trial account, and everyone's trading on a demo, and whatever
Dude, it's
payout
like
you
it's kind of a Ponzi, bro. I mean, if you're trading demos, it's like new money comes in from prop, 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 prop. It's like this person made money, so we'll pay them. You know why? Because most traders lose money. So if it's a Ponzi scheme, like, yeah, it's freaking shady. I mean, again, hopefully prop firms aren't like, who's this guy? I mean, sounds like it is. If you're trading demo, how the hell are they going to pay you real money if you're not actually trading real money? So if
I
it's a
think they
demo
just
feed, it's a little sketchy, dude.
they just pay you with the money that's coming in from, different tests that people are
Right.
purchasing,
So what does
which
that
is
sound like?
yeah, which is a Ponzi scheme, but
Exactly.
I'm not sure if all prop firms are doing that. I noticed it for one.
Mhm.
So it is weird, but I think now I'm more focused on, dollar related assets. I've always liked the stock market. I like trading the indices. Um, I just I wish there was less regulation on my account though versus
Yeah,
these forex brokers where I could take a trade and be out in like 15 minutes if I wanted to.
I
And
know.
nothing there'd be no consequence. But here, even if I'm up and I'm feeling good about the trade, I hesitate to get out because you hit
Day trade.
you hit the day trade flag and then
Yep.
you're done for, which is I don't know. There's just so many things that are just not the same anymore. So I don't really look at currencies. I honestly am thinking about not really focusing on trading as much and just building a long-term account and just buying stuff that I like and not
And
really focusing on the
never
trades.
looking at it. Well, look, dude, for well, I mean, my style in trading forex is I invest. I mean, I will wait for daily, weekly patterns to set up, buy extremely low, sell extremely high, build positions, have a good technical just like rationale of why I want to hold the trade. And I mean, so example, and I've done this for the last year. This is a broken record for most traders that follow me, but dollar Swiss is a good example. Okay. I love the technicals on the dollar Swiss. And, I might be wrong right now calling this as a head and shoulders. Okay. But if this is a head and shoulders, it looks like a pretty good textbook head and shoulders. And right now, I'm just waiting to see if and when this actually sets up with the right shoulder. These patterns in the Forex market as a technically obedient market are pretty much self fulfilling. So if this is a pullback area and this thing pushes to symmetry, that is a trade that I can make a ridiculous amount of profit on. So when I have trades like this, and this has been about the Swiss basket, this is one of my big, like, this is my modus operandi for the Swiss, is like my Forex trading is mostly heavily focused on getting carry, positive swap, and being long against the Swiss, because it's I try to I'm going to try to double my account, right? And that's not me using a ton of leverage. That's me picking certain levels, trading small, building up, willing to take a 5 or 10% risk and having 2-3 times the upside, and I can add to my winning positions. All right. This is, again, this isn't easy because it takes me months. I've been in this trade for over a year, but it doesn't cost me anything other than some P&L fluctuation. I'm getting paid to hold this position. The technicals, you're looking at the Swiss franc that for the last 3-4 years has been at the strongest levels we've seen in 20 or 30 years. There's not that many retail price fees that go back 20, 30 years, right? So, I mean, I look at it as it's a good investment. I'm getting paid to hold the trades. There's good technicals on these positions. I can measure all these moves. So as a Forex trader, dude, I don't care if I'm waiting 2 years to hold this trade. If this 2 years pays me 50%, pays me 100%, annualize it. Okay, so I just invested and made 100% in 2 years. Well, it's a 50% return every single year that I've been holding this. That's how I trade Forex. Sometimes, I mean, and it's not always that. It's like, but if I did that and I can turn 20, 25%, 30% of my accounts, annualize it. Am I beating the benchmarks? Sure. Am I taking a ton of risk? Typically, no. It's all very controlled. So, I mean, don't knock Forex because it does work, but I am very patient and long term when it comes to Forex trading. I hate Forex scalping. I hate Forex day trading. It is impossible to me because I don't want to get up at 2 a.m. to trade Forex, right? I don't want to trade the London session when I should be sleeping and having a normal friggin' sleep cycle. I did that stuff. When I first started trading Forex, I was up every day, 2 a.m. Eastern time, and trade until like noon. I had a 10-hour window. That's all I did was grind from like 2 a.m. to 12. It's exhausting. I did that for 2 years and I'm like, I don't want to do that anymore. So I started gravitating towards higher time frames. So anyway, to your point, trade what you like, trade what you want, strategies you want. You know, I mean, for you, it's like, Frank, you're not that far away from having the account size where the pattern day trading stuff is long gone. That's what I mean, and you got to remember that too. It's like you're restricted because of certain things that have been in place for a long time. But I wouldn't be surprised, and this is a big regulation thing. But look, we have 0 DTE right now. We have the ability to trade options, stocks for nothing. I mean, you can trade a stock for free, dude. You can trade an ETF for free. You can trade options for 60 to 70 cents. You can trade futures for 80 cents to $1. You have all these instruments you can trade. I wouldn't be surprised regulation wise. This is good for business, good for brokers, good for liquidity. Stop making pattern day trading rules. Maybe that's the next big thing, is like all these traders with under 25K, take away that restriction and watch them trade more. That's good for brokerages. That's good for liquidity. Maybe that happens, but there's a bunch of red tape. And what's crazy is the US is way more restrictive than other countries. I mean, look what's happening. If you're in Forex or in props, no longer servicing US clients. I've been seeing it my whole career. I mean, I've had 6 brokers in 15 years of trading Forex because they just stopped servicing US clients. So it's a pretty small pick of the dodgeball team. It's like you went from 20, 30, 40 brokers to now I can pick of 2 or 3. So and they're large and they're regulated, but it's not the same as having options of where you think your money can be treated best.
It's
So
just very annoying because when I used to trade on these brokers, on these Forex brokers, and I do like S&P futures, I was good at picking these like intraday tops, catching like a swing during the day, getting out. Um, if you went down to like super low time frames, which I have tried, they
yeah,
don't really work out. But if we're looking at like a daily move where I think I know where something's going to go, especially in the stock market, I was pretty good at, picking direction. But, with options, I guess I still have that same mindset. I'm so I take a trade, see that it's up, and then I want to get out of it when I'm happy with like 20, 30, 40% profit. And then I realize that I can't take it in the middle of the day, or that
yeah,
I've already taken 3. So if I take one more, I'm going to be out. And
yeah,
so I've been burned like so many times trading options that And if I want to get up to 25K, I
Mhm.
don't want to keep trading as much as I am because it's not really helping me. So it's like, should I just work to build my account to where it's up to that standard, or should I just, keep trading and see if I can figure out some sort of I don't know, some sort of groove. But for now, it's been a little painful for in the options journey. I'm not gonna lie, but
Yeah.
um,
Well,
I've been
so
listening to you and stuff and trying to get more. No, not like
I'm a
that.
terrible influence.
No, I'm trying to learn
Listen.
more about it through you. I'm not necessarily taking these trades you are. I'm just trying to
Yeah.
learn and
Yeah.
figure things out. But it's been
Yeah.
so far it's been a tough journey. It's not that I still love trading, but
Mhm.
I also don't like losing money. And if options are it's on that brink where okay, I need to figure out whether or not I want to keep doing this or not.
Yeah, well, I'll say this on the option side, right? The ability to take off your trade when you want to take off your trade makes all the difference in the world to your strategies, right? I mean, that's why I sent you the look back thing, because if you go in and you're talking about, I mean, realistically, if you want to make consistency in options, it is about small wins and high samples. 1,000 trades at 15% wins, 1,000 trades at 20% wins. It's not about 1,000 trades at 100% wins. It's really not. Like, if you want to collect, you collect. That's why option sellers have an edge over option buyers, right? We've been what you think historically is in a good market to be a buyer, but there's still that staggering statistic of 70+% of options expire freaking worthless. That's not a good thing, right? I mean, if you're an option buyer, that's the staggering like obstacle that you're staring at. Like, most options expire worthless. So sell options. Time's on your side. You want them to expire worthless. You want them to expire out of the money, and you make money. And you're not looking to collect all of it. You're looking to collect some of it, and you just do it over and over. And every good option trader that I've talked to, every good option trader that I see, every good option trader that I follow, they're all that. They are small wins, small wins, small wins, high probability, over and over again. That's what I see. And it's weird to think like, man, I'm risking $100 to make $15. It's weird, right? But the reality is, you say you're risking $100, you're rarely actually taking a $100 loss. You're usually going to risk maybe 30, 40, $50. But if you do the numbers and you look at 1,000 trades, if I win $15, and 1,000 trades, if I were to lose, um, $50. But if I have an 80, 85, 90% win rate, number one, I'm trading with a lot of confidence. Number two, the numbers still add up where I still make money. That zero DT stuff. I went deep in that zero DT SPX, and I found like pretty much the number. If my average day was going to win about $50, $60, I made sure that my average win, as I'm tracking it live, my wins are fine at 50 to $60. I've seen them for the last couple of weeks. It's steady, right? It only takes about an hour and a half to see that. But my losses shouldn't really stretch more than like $400 to $500, because from the win percentage, that makes it a sustainable strategy. But if you take a loss of what your max risk is, which is $1,700 in the SPX, if you take one of those losses, it takes over 30 days to make it up. That's a huge setback, dude. You can have a month of winning trades, and then you take a month out and one loss, but that's a max loss. And usually the market's not making an outlier type move. Most of the time, the market's moving within that fraction 1%, which is where we should be trading. Your options trading, like I said, I mean, I will teach you everything I can teach you in options, but I do the same thing over and over again, man. I've got, 5 core strategies that I focus on, and then I've got some extra stuff where I can do all sorts of creative things. But I have a plan. It's like, if I'm directional, here's a couple strategies. If I'm not directional, here's a couple strategies. If I'm trading volatility, here's a couple strategies. I mean, but everything I'm looking at when I do earnings, when I do everything else, this when we talk about our trades, I'm only going after like 15 to 25% most of the time. Earnings is a little bit more exciting because you can have a blowout move and you can go after, man, I just closed out for 50%. I just closed out for 100%. Those are cool. Those are exciting, but that's not the norm. The norm is you should be like living with the 15 to 25%, because that's the highest probability, and be happy. And that just takes more frequency. So
Yeah.
again, I don't want, look, and I know the frustration where I mean, right now it's like I heard this really interesting like journey of trading, right? The first stage is darkness, where you don't know anything. You start to dabble, you start to learn. It all seems overwhelming. You're just trying to get your feet, get your feet underneath you. And then you go into the second stage, which I believe is complexity, right? Where you start to add more strategies and understand more strategies. Maybe that's where you're starting to stabilize, not really lose money, but then you realize like you're trading too much or trading too many things, and you just try to go back to then the final stage, which would be simplicity. You find a way to show like what works, you've seen it work. Now it's about focusing on that and not trying to be the everything of trading everything under the sun, but focus on your core strategies, focus on what makes you confident. So, I mean, maybe right now, like you're right there, you're between like darkness and complexity, where we just have to, I don't know, simplify it a little bit, focus on what has been working and why it's been working, and maybe the easier trades are just out there. Maybe the biggest thing for you too is duration, right? Like honestly, and we can talk about this offline, dude. But going to like 5-day, 10-day short term stuff, historically speaking, it's not that great. A lot of the trades I'm testing are 30, 45, 60, 90, 360 days. Like they're bigger picture moves that I don't have to hold that long. I mean, I did leaps yesterday in this testing for the last like decade, leaps. And my average trade is only open for about 30 to 40 days. So I go out 360 days only to collect the actual income that I want within 30 to 40 days.
Right.
That again, that's a seems very weird and doesn't make any sense. But that's what's awesome about the asset of options is like you can go out and have all these elements of options trading generate income, and you can do it regularly. Like 30 to 40 days, if you're making income, that feels great. And you're doing it with like this very safe, like long-term mindset, but it just time works in your favor when you're selling options as opposed to buying. So
That just made me think of something. Um,
light
Long
bulb.
term, we saw we saw what was it, pending home sales today came in lower than expected, but it was also higher than last month. Either way, it's still negative. But
Okay.
um, we're talking about less people buying and nobody selling because high interest rates. Um, I guess there's a large supply of houses that no one's buying. Um, so
Maybe.
I don't know. Just I guess this consensus I'm thinking is that nobody wants to buy a house right now. So different from like the financial crisis where people owned many houses and were
Sure.
defaulting on all these loans. It seems that no one really wants to buy anything.
Sure.
Um, but we see home prices unchanged. So
Right.
I'm looking at the REIT, REIT
Yep.
on that ticker. So that's been pretty steady too. But I'm thinking at some point, and when you're talking about long term, you're talking about duration in the trade.
Hmm.
There's another ETF that's inverse of that, DRV. That that is, I think, close to an all-time low. And every
Oh, dude,
time it
you're gonna do
bottoms out,
a triple leverage real estate?
well,
Oh
what's a
boy.
single leverage real estate of REIT?
Let's just go let's go real estate bear and see if it shows up. Real estate bear. So I am not a fan. I've been burned so many, well, not so many times. I've been burned about 3 times on leverage ETFs. So 2x, 3x. Once you realize that, the word is contango or backwardation. That just means that price is only going to work short term. If you're using those leverage instruments, you got to be spot on with timing. It's not meant to be held. So if I go real estate bear, maybe nope, DRVV is triple, 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 triple. I don't know, dude. These are all triple. Yeah, these are all triple leveraged. I don't see any single or double. Let me see if there's a. I'm just gonna Google search this. Is there a 1x Real estate bear ETF. Let me see. ProShares inverse ETFs available. What's that?
I was just saying, there's got to be.
I'm sure there is. Oh yeah, REK. REK. REK.
Yeah.
Yep. So this is inverse real estate ETF list. There is DRV, which is what you said. There's SRS, which is a 2x leverage, and then there's REK, which is a single leverage. So REK right here, this is a ProShares real estate. There's your inverse. So if real estate goes down, then this is one you can be long on. Now, again, you can read here mostly at the bottom, okay? Most of these are not meant to be held longer term. Now, a single leverage, you can essentially hold a little bit longer, but all these are typically repriced sometimes every 30 days. And that's where you have like that backwardation contango, which means like there's just this reversion to it's always repriced against the underlying, and it freaking is sometimes impossible. The only real money I made on inverse leverage was 2020. And when oil crashed, I was long double and triple leverage oil ETFs. Like that was a great in long futures in oil in 2020. Classified here, not a leverage fund. Daily rebalance, inverse exposure exposes the fund to issues compounding the path of dependency. Long-term returns of the fund are impossible to predict when compared to its beta 1 cousin IYR. For the fund, investors must monitor and rebalance their exposure whenever possible. Index undergoes annual reconstitution and quarterly review. Dude, you got to have a strong sense of direction. Strong sense of direction to trade inverse. I mean, if we're going to see a market crash, I like, SH. There's, again, I do single leverage because you can trade those with options. That's the thing is like, rather than trading a 2x, 3x, you can trade an option around a single leverage and get more, juice out of it. But I don't know. I'm really skeptical of these. Like they're good for hedging, but man, you can't hold these for more than like 1 to 3 weeks, 1 to 4 weeks tops. Like it's just not great. So just be careful.
I'm not saying for now.
Yeah.
But I think looking into the future, this is something to keep in mind because
am I gonna call you Frank Burry from now on, dude? You're gonna short the housing market?
Eventually.
Okay. Yeah.
But we all know that home prices are going to come down at some point because mortgage rates are going to fall. And it could be several years from now until we see that, because I think the projection is still interest rates aren't going to hit like under 4% until 2026. So
sure.
I don't know.
If we have a crisis, they'll hit sub 4% way faster than that. If we have a recession, we'll be most likely the Fed would cut quickly under 4. I don't know. They would slash a lot of things. If we have a recession that gets pretty nasty, our rates are going from 5% to probably 2.5%.
They can't. I mean, they shouldn't do that though, because
they shouldn't. But they look. What they shouldn't do is go to zero. That's the problem. We've gone from 4% to 0, 4% to 0, 2.5% to 0. That's what we shouldn't do. We shouldn't just keep going to 0, right? I mean, we have 0.25%, but I think
that with that we shouldn't go. That's a whole other inflationary issue. You go to zero every time. Dude. That's the Fed. The Fed should be designed for crises, but they should not step in on every little.
I know, but look at what they have done, and this is why the market is so conditioned. Where it's like, we're down 1%. Where's the Fed? We're down 3%. Look at April's correction. Where's the Fed? I mean, Silicon Valley in 2022 with the regional banks, or was it 2023? That was like that little blip on the radar in 2023. It's like that was squashed by the Fed, and understand that 2008 taught the global economy a lot. Like there are stress tests and things in place to prevent 2008 from ever happening again. Now, it doesn't mean that it can't. It can rhyme, so to speak. It can be a different look, but those like circuit breakers are in place now than they weren't before. I mean, we talk about the GFC in 2008. We talk about Black Monday in 1987 or .com bubbles. It's like circuit breakers weren't as liquid and as right in your face as they are today. So again, that's not saying that we're immune to something awful happening, but the reality is it's just more liquid. There's more crap in the markets. There's more derivatives on top of derivatives on top of derivatives, and maybe it's all a big house of cards. But dude, if the market goes somewhere, I mean, I guess the worst case scenario for any investor would be like, we just go sideways, right? I mean, could you imagine staring at a 401k and you're a passive investor and you've been in a drawdown for 2 years and you're now, oh wow, my, $500,000 401k is now up to $540,000. It's been 2 years. Like, that's not anything to get excited about for a passive investor outside of it's up, you know? But for us, it's like we've seen a swing and we've seen a swing. And I just think we're the ones that are way oversensitive to what the market does most of the time, which is it just finds a way to grind. It ignores a lot of crap. And I don't know. I think it's just we overkill it because we can put so much content out there, right? And we can see this stuff. There's never a lack of data. There's always something to talk about. There's content that is overkill. But the reality is, what do you think the market's trying to do at the end of the day? The best companies in the world are trying to do better. They're trying to make more money. Corporate America is freaking greedy, man. All they want to do is improve their bottom line. And if they do that, we can invest in that. That's all the market is for, So that's why buying the SPY or buying the indexes, that's essentially what we're betting on. The best companies in the world find a way to be the top dogs. Well, if that's enough to drag the market higher, cool. We can make money doing that. Is there a reality? Sure. Maybe it's, the broad market underperforms and we have a slowdown. Okay. So what does that look like? Maybe it's sideways, right? I mean, heaven forbid trading gets boring all of a sudden. I mean, trading hasn't been boring since 2020. So that's a whole other thing. It's like everyone expects all this excitement and all this crazy volatility. It's like, I mean, why do you think I'm looking at just daily trades on the SPX when nothing happens? In 60 minutes, I can make $50. Doesn't seem like a lot. I mean, I can double down and make $100 a day if I wanted to. It's just more contracts and more risk, but it works, And until we're dealing with like crisis and high volatility, it's like, just let it do nothing. Let it do its thing. If we can make money doing it, I'm fine with that. So,
Yeah,
anyway,
I'm with you. I think from, just a consumer standpoint or just the average person, putting rates to zero and then hoping everything will be okay will not always work. And it's going to hurt, it's going to hurt us, like our generation and after us. The inflation problem would just persist if we just kept, letting the Fed step in.
I know, man. It's not like the Fed is not the answer. I mean, there's a lot of problems out there. There's a lot of problems under the surface, which I, don't agree with. But at the end of the day, man, it's not in my control. If the Fed steps in, it's not my control. If the Fed doesn't step in, it's not my control. All I can control is what I trade, when I trade, and how big my trade sizes are. That's all I can control. So that's it, man. I figure out how to survive, try to make some money, stop complaining about stuff I can't control. Stop guessing and speculating on stuff I have no idea. Nobody has any idea, but there's still ways to make money. So after all this talk, that's really what it boils down to, is like, how stoic can we be about, how stoic are we about trading the markets? Can we just find a way to agree that there's ways to make money? If we can do that, then that's why we're still here. But I know that this conversation, if it gets worse, can be so frustrating where it's like, I just don't want to, I don't care. I don't care anymore. It's too much work. It's too much this. Yeah, it's not for everybody. I get it. So anyway, but here we are.
Yeah, still trading another day.
Another day, man.
But yeah,
another day, another dollar.
It's time to get off. I'm done.
You're done, huh? All right.
Yeah,
well, thanks for your hour.
I gotta do some stuff.
All right, man. Well, I appreciate letting me have the extra time, Chandler and everyone else. Like, I don't know what this session became other than it was fun. It was therapeutic. Felt like we get some stuff out there. We can cleanse a little bit, So, but at the end of the day, man, we just keep grinding, keep trading. So, all right, man. I appreciate the time, Frank. Thanks, everybody, and we'll talk to you all soon. Thanks, man.
Thanks, everyone. Yep.